Avi, what is the problem with housing affordability?
I think there's so much information out there that's suggesting that it's unaffordable and this is something new. But if I was to tell you the headline was housing affordability is a concern, everyone's FOMOing into the market, you would think that that headline came out now. But in reality, that headline was from 2008 and there was one from 2015. So the reason I bring that up is because that hasn't changed. And I don't think it'll ever change. I don't think it's unique to our generation. I don't think it's unique to the young generation. I think it's always been a concern. I just think that there's more eyes on it now and information spreads a little bit more.
So you're saying that there's always been an issue as far back as many people can remember that housing has always felt unaffordable.
Correct. Yeah.
And there's some data that I've seen, and again, I don't go into the numbers. I'm the type of guy that sees a reel on Instagram and suddenly it's truth. So they're saying that if we look at salaries and housing prices, is there a discrepancy as shown in those that housing is getting away from salaries?
Yeah, definitely. I think if you look at, say, Sydney, for example, which is probably the most expensive capital city in Australia and amongst the world's worst affordable cities in, across places like Hong Kong, Singapore and whatnot. But when you actually think about it, when people are going, I want to go and buy a house, they don't even think about, I'm going to go and buy a house in, the middle of Mayfair, or I'm going to go and buy a house in the middle of New York City. But we're still so used to this idea that everyone should afford a house in Sydney. But the reality is Sydney's becoming what these cities were 10, 15, 20 years ago. So I think we're continuing to head down that path. And I think we're eventually going to get to a point where people who have made something of themselves, have gone above and beyond, have done something different, save well, invest well, they can stay in Sydney. But I think the reality is, and I was born here, I've been brought up here, so it's sad to say, but I think a lot of people are going to have to find other areas to move to.
This is funny. So I was in Bondi for 5 years and all my friends are still there. And I would consider myself the top earner out of all my friends. And I keep whispering to them, hey guys, I can't afford to live here. You're fucked. And I say it in the nicest way possible. And I keep sending them listings of where I live. And I didn't realize at the time, but myself and my other business partner, James, when our business was doing really well, we both decided to move away from the city. And it was because we're in long-term relationships. Granted that my fiance lives local, but then also we needed an industrial space for this very episode right now. We needed space to film content. I made it to 1 million followers recording on my bedroom floor and with just a camera in front of me with a little shotgun mic. And I kind of wonder if I'd made that decision a little bit sooner, I could have, maybe done better. I don't know. But like you say, everyone kind of holds on to that location where they're at. The one thing I would say is, at least with the unaffordability in Sydney, part of me gets it. And the same with our tax rate. Although an abhorrent and slightly excessive tax rate, you're in Sydney. Relatively safe. Obviously, we had a tragedy last week in Bondi, but ultimately, very safe. From a theft perspective, living in the eastern suburbs, you're almost in paradise. So are those house prices correlated with that lifestyle or generally this demand and supply conversation that everyone's saying online?
I think it's both. So you've got, just from a structural point of view, there's simply not enough houses being built. And there's various reasons for that, whether you go council approvals, and this is not just specific to Sydney, like this is all across Australia. There's parts of Canada that go through the same thing. So structurally, they've got an issue with the council's not approving certain things because they've got these structured rules. The people working at the council, they also are hard workers. So eventually you get to this point where people aren't getting houses approved. When they finally get the house approved, they aren't getting finance approved because it's a lot harder because based on what the bank's rules are now with buffer rates and things like that. And then finally it comes to completion. Now there's so many companies within the building industry that have collapsed. So suddenly you go, well, if there's no incoming supply, and then on the flip side, you've got a mass amount of immigration coming into the country and it continues to be at that pace, which we've never seen before, you simply have a structural issue here. And so while many people feel like they can't buy, the ones that can are just going up and eating up the entire market. And so what you have is this big disconnect of, the rich get richer, the poor get poorer, and then it's just the collapse of the entire middle class. And that's playing out in Sydney specifically, but all of Australia. And you got to think Australia's unique in that the government can go, we know everyone wants to come and raise families here. It's safe, it's beautiful, the weather's amazing, right? So if that's the case, we can always just turn up demand when we want. And the government's incentivized to do it because they make so much money off taxes when it comes to the property industry. So it's almost this protected industry, whether it's good or bad, it's up for interpretation. But at the end of the day, you've got so much support from the government themselves. They keep coming out with all these policies and these schemes. It only affects one part, which is demand. No one's looking at supply. And even if they want to go into supply, it's not like, hey, I can just go in and turn on a machine and suddenly we've got houses tomorrow. It's the period from getting an approval to actually coming into the market is like 18 to 24 months. And so when you've got everything post the pandemic, you've got the time it takes to build a house takes longer by 50%. It costs more by 50%. And productivity in that entire industry has gone down. So you suddenly don't have enough supply coming in, but there's increased amounts of demand. So prices only go one way.
So you're saying that if we look at stamp duty, the tax on purchasing property, you're saying the government are incentivized to say, okay, we're going to let in 1 million people from overseas. They're all going to need housing of some respect. And what's going to happen is that's going to push rent prices up, property prices up, and therefore we are going to make our money on the taxation of people purchasing property.
Yeah, correct. And then the other part to it as well is people sort of go, oh, why we, have all these migrants coming into the country? Because underlining the entire economy is that as per capita, we're in a recession in Australia. So if you don't have enough people come into the country is technically in a recession. While right now it looks like, hey, the country's doing all right, unemployment's not bad, this and that. It's because we've just introduced so many more people and the government knows that maybe this is the only way we survive anything that happens. And again, it's unique because Australia's in demand. People want to move here. Now, is that going to change? I'm not sure. But I think we're in a position now where a lot of people locally are going, well, now everyone coming here is willing to work harder. They might be bringing more money and they're going in and they're buying a house earlier than I am. I'm now getting pushed out of the place I've been in for the last 40 years, which is pretty sad.
Yeah, it's one of those things where, especially in the UK, there's this notion that if you're a landlord, you're a bad person. You've just taken a property away from someone that needed it. You've taken a property away from someone that's just been saving for 5 to 6 years. There's also, first of all, I'm not sure how well you know the UK property market, but the kind of business of running and being a landlord in the UK is becoming a lot more difficult. Labour government have come in, they've changed a lot of the rules, a lot of people are leaving. That's not such a thing in Australia because there are incentives and rewards for being a property owner. Can you talk me through some of those?
Yeah, for sure. So I think one of the biggest ones is this negative gearing tax. So it comes up literally, I've been in the market investing for the last 12 years and it's come up 20 times in the last 12 years. And it always comes up, especially when it comes to election time. It's something we're going to consider, guys, but then it never actually eventuates. And the way it works is that, put simply, if you make more money so from the income you generate from the rent versus the expenses you have in holding that property, it means your positive cash flow, which means when the ATO or the tax man comes in and says, James, you make 100K plus your property made 10K, I'm going to tax you at 110K. The opposite happens when it's negatively geared. So people go, the accountants will often tell you, hey, you're making too much money, and so you should go and buy a property because now you're going to get some tax benefits. So they say, okay, well, you make 100K, but your property is negative on paper by $20,000, which means now you should get a refund for just holding that property. So by having incentives like that, people are arguing that, oh, well, if you remove those things, people aren't going to buy investment properties. Problem is that it's not about the property itself. It's not the whole landlord argument. It's the fact that the government now, it might be a conspiracy, but I think the government's gone down this path going, rather than them pointing the finger at us and saying we're the problem, let's just get everyone to fight between themselves, landlords versus tenants. Thing is, there's some people that don't actually want to own a property. I've got tenants in my property that have been here longer than I've held it for. They have no intentions to buy it. They just want to rent. Some people don't have the upfront cash and they're okay with that, right? So when coming back to this whole argument of, well, is it landlords? Is it the government? The government's gone out and specifically gone, we need inflation every year. So if you simply try and save your money, you're screwed. So after 10, 15, 20 years, you're going to fall further behind. So in Australia, you're going, the policies support property prices to go up. The currency we save our money in is dog shit and supports that I need to invest in assets. Why would I go and invest in Bitcoin or altcoins or shares? I don't understand that, but I understand a home. So let me go do that. And so suddenly you have this entire country that's so infatuated with property because it's the only way people can go, I can hold on to my wealth and I can save something.
When I first got here in 2016, I couldn't believe how cheap it was to rent. So I was in Bondi in an apartment with two of my best friends. My rent was $300 a week. And we do weekly in Australia, so £150 for people in the UK. And that was extraordinary compared to the UK, where living in London is incredibly expensive as well. So then I moved around a few times, and my rent, even during lockdown, lived in a 4-bed with, again, my best friends. I had the nicest room with an ensuite and a sunroom, and it was $450 a week. And from that, for me, it gave me so much freedom. I could travel, I could go away. I struggled to get a visa here for about 4 or 5 years. I'd go home for 6 months and keep my bedroom because it was $300 a week.
Yeah.
So I would just keep it there. And if any of my friends were in Sydney, I was like, oh, I've got a room, you can stay at mine, whatever. And I always did wonder to myself, I was like, okay, this property is worth $2 million. It's in Bondi, it's by the beach. There's 3 of us paying 300. When I did the maths working backwards on the mortgage, I then came to the conclusion they can't be making money. And my assumption was that, oh, maybe they have just paid down half the mortgage. Maybe they put 3/4 of the property price in cash into the property and their mortgage is quite small. But the reality is that this for them was a tactical loss. In Costco in America, I believe that the roast chicken is their biggest loser. So they have a tactical product they lose money on to get people to go in and to become a customer in the store. But in people's portfolios in Australia now, they have their tactical loser, which is their housing. Now, for me, I've gone through 50 shades of this. Up until 2022, I was actually against the idea of buying a home. Reason being was I spent most of my life very poor. And not poor as in, didn't have food at home. I would spend all my money. I'd live out my overdraft, even running a PT business. I think the highest I ever saw my bank account get to was £2,000, $4,000. And because of that, renting was easy. It was flexible. It was one of those things that was in front of me that meant I could chop and move and travel and be reckless or whatever. Then when I bought my first home, I think I was quite naive to the security aspect of it. And that security can come from wanting to modify the house, wanting to put a nail in the wall, but also just having a base. I think because I'd spent 3, 4, 5 years living out a suitcase, renting, not having a visa, I felt like a plane that couldn't land. So when I got my residency, I wanted to set up base somewhere.
Like no one can tell you to F off.
Yeah, pretty much. Well, they still can until I get my passport. So for some people, so I've been on both sides of it. Renting for me, I still think is fantastic. And I had a friend come up to me the other day and he says, should I buy a property? And keep in mind, I'm not the expert here. And we're going through the maths on it a bit. I said, you know what? Unless you've literally got several $100,000 saved, ready to go, ready to do something with, I said, just rent and stay stress-free. Because I said to him, I'm earning more than you. And it was actually a bit stressful for me to buy a house. So I've lived both sides now. I do enjoy owning, but the advice you get in the onset especially was to start paying down my mortgage. Now, is that advice? Because in the UK as well, people say, oh, don't pay down your mortgage. That's ridiculous. That's stupid. But interest rates were quite high a couple of years ago. Talk me through the general advice for people. They've maybe loved renting their whole life. They've then scraped together a bit of money. They've invested in a property. Should their focus be on investing outside of that or paying down the mortgage or both? Or how does it work?
Ultimately comes down to what the end goal is. And I'm just going to assume everyone wants to go, hey, cool, I want to do this to my boss and not have to work again. And I want to retire early on my terms. So if that is the goal, anyone that's sitting there just trying to pay down their mortgage is doing it the wrong way. And if you look at the numbers and you break it down, you go, let's remove the emotions of it. Let's purely focus on the logic. So if you think about it, you have $1 million mortgage. You might get an interest rate of 6%, right? Now it might be lower, might be higher. That means every year you're going to pay $60,000 towards that mortgage, right? In just interest. So that would be the equivalent of you just renting somewhere because it's just dead money, right? As people call it. Now, if I put $1 into that, that means the best I can earn is a 6% return because I'm paying down mortgage. So you're taking a bet that you cannot get greater than 6%. Now, obviously, you could go down the path of, if I put it in my business, it's infinite results. If I go and put it into another property, what does that look like? If I put it into the share market, I might get 10%. So there are other avenues you could go down to get further ahead. Now, most people get taught you buy a house and you do everything possible to pay it down. So by the time you get to 60 or 65, you have a house now paid off. But what else do you have? Now, if you've got a couple of kids, are they going to get a head start? Well, maybe they get a head start by staying at home rent-free. But outside of that, you're not giving them any large sums of cash or you're not giving them any sort of investment properties or investments or assets. They have to start from ground zero. And if you thought it was hard now to buy a property, imagine what it looks like for our kids in 20, 30 years. So the idea is that if you want optionality and you want safety, it's actually the reverse. So you got to go, well, I've got to have more options to have safety. And that might mean that instead of me buying the $1 million house, maybe I need to go and rent and I need to invest in areas that make sense. So that's the whole concept of rent vesting that came up and it's become quite popular now. So the idea is that if I'm going to go and pay down my mortgage, the max return is 6%. But if I can go and I can use the equity, or if I don't have the home, I can use all the cash that I was going to put into the one home, I can go and buy investment properties, rent wherever I like. Suddenly you're, in parts of Sydney, you might move to Melbourne, you might move back to the UK. I've got flexibility. But those investment properties now gives you options. So just like you can't sell a part of your home, you would be in a position now to go, if I've got a son and I want to give him something, why not give him one of the investment properties? Or at least take out the equity from one of them and give him a head start. You have options. You don't want to get to 60 and say, yes, great, I did what everyone else said. I'm going to have my house paid off. Fantastic. Now what? Now you rely on the government to tell you what to do. So you've gone from having a boss that tells you what to do for 40 years, then now you're relying on the government and you're screwed either way. So I think when people run that whole game out, they realize that the end goal is not really what everyone told them that it was. But by the time they realize, it's suddenly too late.
So I'm in a position now where in the onset, I did just start paying down my mortgage. Now I've nearly paid my house off in 3 years because I hate debt. I hate it. I didn't touch a credit card till I was 29. My dad just said to me, never get a credit card. He knew what I was like, reckless, stupid, young, dumb. So even buying a house for me was incredibly stressful because although it's the norm to have that kind of debt, I'd look at my bank account and I went from living within my means and earning more than I spend to suddenly feeling generational debt. I'd never seen over $1 million in debt before and it freaked me out. And so I've been trying to pay that down, obviously my own kind of personal preference with that. But now I'm getting to the point where I made a repayment the other day for $70,000 and my repayments changed by maybe $40 a week. And then I didn't feel happy, I felt panic. I was like, this is the worst use of this cash possible, considering that 47% of that's got to go to the government anyway. So I've now had a bit of a change of heart as to what I do with this. So like everyone else, there's two issues that I face. One, my friends that earn less than me are buying investment properties, which is a signal to me that something's going wrong here. I'm like, how can they be smarter with their money than I am when I've nearly paid off my house in 3 years, right? That's annoying. But the second thing is, so I look to the property market with complete naivety and ignorance. I don't know what a property is worth. I don't know whether I'm getting a good deal or a bad deal. I don't know if it's a good neighborhood, a bad neighborhood. I don't know how the plumbing is on the house. I don't know if the electricity works. So many of these things, but also because of all the things aforementioned before, let's say I had the liquid capital to invest in a property that's $1 million. Part of me, and tell me where I'm wrong here, part of me wouldn't mind if that was within a half-hour drive, so I could inspect it, check on my tenants, whatever it is. Could be wrong. Then the second thing is there, I look at it, and I go, that doesn't look like $1 million. And I seem to think that the kind of value that a house gets, to me, can be overinflated. So if you look at a $4 million home, and anyone in the UK, just half it if you want pounds, sometimes I think a $4 million home is 4 times better than a $1 million home because so many people are competing for the $1 million home. For people that are looking to buy their first or maybe even second property, that $4 million home is so far out of reach, there's less competition there. Whereas the $1 million home, everyone wants it because everyone's trying to get on the housing market. Everyone's trying to stop their money degrading. So when I look at that property, I go, I'm getting a bad deal because I'm paying over the odds. I'm buying a $700K house for $1 million just to invest my money in the right place. So I'm already losing 300, let alone stamp duty, just to get on there. So is this a normal apprehension that people have? I've just been paralyzed by that. So I'm now almost disintegrating any liquid capital I have because I'm paralyzed by those insecurities.
There's two parts. So one, you mentioned that you never wanted to get credit card because your dad told you to not do that. Debt scared you. First time you see minus 1 million. I remember feeling that too, except it was on like 200K. Didn't do the $1 million property. These are all things that like go back to the PTSD. So maybe you go for a swim, you injured yourself. The next time you get into the pool, you're going to go, oh my God, I don't want to do that again. Same shit is that you've grown up going, I need to avoid the one thing that people told me, right? So you need to get that part rewired first. And it's hard. Like, it's easy said, but for everyone, it's difficult because, no one wants to go back to where they came from, right? So you always go, I want to make progress. So you think that, okay, I've got a house now, I'll pay it down, I've got no debt. And then what's next? But if you actually look at the idea of building wealth, the people that do it are the ones that are willing to take the risk. And unfortunately, if you've got some baggage there, you got to address the baggage first before you get onto, okay, I'm going to go and take the risk. The other thing you said was, maybe I can buy something half an hour away, in my own backyard. A lot of people make that mistake because they're like, well, I grew up here. I know what this is like. I know the people down the road. The shops are mad. The thing is, you're the perfect target market for that area. And so that's why you've got this perception that this is the best area. But, I drove down and I was like, cool, like, it's nice. I'll come visit, but I can't live here, right? So I'm not the right target market for it. So every time you look at whether it's a business opportunity or you're looking at a different market, you've got to go, who is the right persona for that, right? I'm getting that property advertised to the right people. I'm not the right target market for it. So what happens is you go, even though I think it's not worth $1 million, I'm not the right target market for it. But the right target market might actually think it's worth 1.3. And that's why there's so much demand for that. So that's the other side of it is, if you go and pick something up that's local to you, realistically, how often are you going to go see the tenants? Why would you want to go see the tenants?
More insecurities that they haven't turned it into a crack den after I've just renovated the kitchen.
Which is why you have insurance. And so everyone often talks about like, oh, if I've got multiple properties, the tenants are going to ruin my property. Okay, first thing you do is get insurance. So part of you, and I'm, hopefully people don't see it, my tenants don't see this, but half of you almost wants them to ruin the property because then you get a new property, right? One of the questions I got asked very early on in 2020 was over a phone call. They're like, what if someone burns down my house? I don't have a house anymore. I was like, guess what? You're going to get a brand new house. So if we alleviate that problem and you go, well, okay, insurance is going to cover that. Yes, there's going to be a few things that need fixing. There's probably a tap, there's this and that, but then you have a good property manager. So now all you're doing is you're trying to reframe it to go, am I buying a house to be a landlord? No, you're a business owner. So when you start thinking about it as a business owner, you're going to go, my employee is the property manager because that's what I pay them. Now I need the best customer, which is the tenant. The tenant wants that. It's not like you're forcing, hey, you should stay here. It's they are looking for properties to rent. That's why we have a rental crisis here and many parts of the world. Houses aren't coming onto the market. People that are buying houses, like foreign buyers that buy it here, they're just like, I'm going to land bank, put my money and just protect it. I don't even care if I earn any income. So that's been happening a lot as well. So suddenly you got all the rental supply go down and suddenly people are going, I want to rent here. I want to live here. I have no intentions to buy. I don't care. I can't afford a $4 million house, but I can rent for $2,000 a week. I can get a few mates in, just like you did with your mates in Bondi. You didn't have intentions to buy that place. But if that rental property wasn't available because the landlord didn't buy that, suddenly there's no housing available for you. Does that make sense?
Yeah, it's one of those things where you kind of see it through, like exactly how you say it. Look at it as a business. But the only issue then I have is, how do you distinguish the inflationary aspect on it versus the profit? So what you're doing is, then the beautiful part of property, I suppose, is you get 100% of the asset for a 20% down payment, which is where the crazy growth can really come from. But my concern over the years has been, okay, people go, oh, my house has gone up 10%. I go, cool, but every other house went up 10%. So that move for you to go up is not as clear as you might think it is. So let's say you have a property and it goes up maybe 5 to 10% each year, whatever. You've got some costs. You've got the property manager you've got to pay for. You've got stamp duty. You've got bills and utilities and all of these things. Come the end of it, if property hasn't raised that much, but inflation has, what if you end up in a pretty, underwhelming position from that? That would be my annoyance. So say, cool, found the property I want, paid the stamp duty, paid the property manager, put out all these costs. Then in 10 years' time, someone goes, oh, your property's gone up 200K. I go, yes. And then you look at all your bills, all your expenses, and then actually the rate of inflation, you go, oh, well, you actually could have got more in an index fund or you could have got more in shares. How do I navigate that completely separate insecurity?
Two parts to it. So break it down real simple. If you go down the path of shares versus the property aspect, there's leverage play, right? So if you put 20K into shares, you're getting a return of 10% on 20K, $2,000. The same amount, if you go 20% into a house, obviously you're going to need a lot more, but you get the leverage play. So if I buy a place for, let's call it 100K into shares, at 10% growth, that's $10,000 a year, and it compounds. That same 100K gets me into a 600K property. that 600K property grows at 5%, I'm now making 30K, right? Because it's on the actual asset value. So when you think about it from a cash on cash return, the first example gives you 10% on the cash. The second example, even though grew by half the amount, being 5%, because I put in 100K and it grew by $30,000, I get a 30% return, right? The other part to this is that the way it works, at least here in Australia, is you can go out there and use the equity. So the property grows in value by $200,000. I can go to the bank or I can go to the broker. Hi, my property's gone up in value. I can borrow up to 80% of that new amount. I take that out and now I can rinse and repeat in a different market. So what ends up happening is at any given point, there are markets that are absolutely booming. There are markets that are actually dropping. But people don't know about that because you only know what you know. So you just think if my local backyard has grown in value, that means everywhere grew. No, your local backyard might have grown by 5%, but 3 suburbs down actually grew by 10%. So the idea is if you do it the right way, you would always be in the right markets. And as long as you hold it for the long term, you're going to get the return of, what averages out to be 7 or 8%. The other argument that you had was around the inflation component, right? Is what happens in 10 years' time if inflation just eroded all that gains that I had in property? This is the beauty of having debt. So a lot of people right now, they get concerned because they're like, interest rates are going up or they're going to go up because inflation's really high. You can pay your debt down with tomorrow's inflated dollars. So imagine the person that bought the $1 million house 10 years ago. They took up debt of $900,000, so 90%, and they said, I'm not going to pay $1 down. Their LVR, which is loan to value ratio, 90%. It's high risk. But over 10 years, that property is now worth $2 million, but the debt's still $900K. 10 years ago, what was the median income? And you back yourself to go, okay, I can at least make more than what inflation is in terms of income. But you're still going to have the $900K worth of debt. And so the people that bought 30 years ago for $80,000, if they paid no dollar down, even if their property is now worth $500K, they're going, I can sell this easily, pay off the debt. I can just use my own income, pay it off, and now I've got an asset debt-free, which is where the compounding nature of it, when you actually work out inflation versus that asset value, that's why people often call property an inflation hedge. Because to go and build the same thing in 30 years' time, the materials have also inflated. So that's why you always have the price pumping up. And then when you decide to sell, you'll have all the debt on your own your own property. Let's call it $1 million. But if all of your values have gone up to $4 or $5 million, you could sell that, pay off your debt, live debt free.
If I was to put my tinfoil hat on here, the fact that I have to ask you these questions legitimately at 36, they're talking about it. Your YouTube channel, I've watched your content before. When I watch it sometimes, I'm thinking the whole system is broken in respect to how we're led to believe you just work and you retire. You buy, you pay it down. I think that most people go through life thinking that's what you do. And then, when you retire, there'll be a pension for you. You chip in a bit over the years. You'll get looked after. This isn't the case. And if anything, people should be told straight away from their first job, you need to invest almost to survive. Now, you've said in, I can't remember which TV interview it was, where you were saying that someone considering buying a property, they should buy an investment, not a property to live in. Someone out there just on the cusp, they're looking around for a new property to move into. They found a nice area they want. You're going to say, stop, rent, get an investment. Talk me through that.
The way the banks work, if they see that you're purchasing a property for yourself, your borrowing capacity goes through the floor. Once you've purchased that, think of it like the biggest roadblock. I got taught this early on. I was like, yes, I want to buy my own place and have my own place and it's going to be cool. And I got told that that's going to be your biggest roadblock because now you've got an asset that, sure, on paper could go up in value, but you generate no income. Now, if you're living at home, you have no rental income, as in a rental expense. So you're putting yourself in a position where now you unfortunately have to pay down that debt or you have to increase your income to be able to get into your next property, all right? When you purchase your actual place to live in, I'm sure when you purchase your place, you were like, hey, I want to know if the kitchen's nice. I want to know if I can see out the windows, water here, blah, blah, blah. Very emotional. You don't care if it's going to go up. And I've just recently now, came out on YouTube and told people that I've bought a place and it's my own place. And I could have afforded to buy this like a couple of years ago, but I did it now because I've got the investment portfolio and now I can buy the dream house. People get caught up in this dream of saying, well, if I've got a property, every property goes up, especially here in Australia. that's not true, because there's plenty of people I've spoken to that bought the wrong property at the wrong price. If you went in and you're emotionally involved in that property, guess what? You're paying way above what it's worth, all right? When it's an investment property, it's very much just numbers. So you've got to go, okay, if I'm willing to pay this much, this is my return, this is what it could look like. I don't care if the kitchen is nice. I'm not the target market. I'm not looking at this property to say, how can I live there? It's going, that's serving the purpose for the person that wants to live in that property as a tenant. And for me, it's serving the purpose in my portfolio. So if people came out and still get told, for the last 5 odd years, I've been paying like rent vest. Rent is not dead money. You're not poor if you rent. We still have plenty of people still go out there and buy their own place because it's emotional. And unfortunately, this is the reason why not everyone's wealthy. If everyone was doing the same thing and you went by the system, which was go to uni, get a job, get the house, pay it off, everyone would be wealthy. But there's a lot of people still struggling, and now they can't even get to that point. So if you can't even get into your first home because you're thinking it's going to cost me $1 million, I would say, okay, well, you need to get some sort of assets. And if that means that you can get into a market that's, slightly lower in price.
It's so true what you say. When I was renting in the beginning, even when I told you living with my best friends in Bondi, that $300 a week, apartment was a shithole. Didn't care. Kitchen was a shithole. Didn't care. Best years of my life. We got a comfy sofa, a cheap TV, and even our laundry, we had to go out the flat, and it was like a shared communal area with like hanging lines to hang your wet stuff up. Didn't care. It was the happiest years of my life. And we were in Bondi Junction in a really old apartment. And you're completely right. When it's not emotional, because it wasn't buying it to own it, it was putting a roof over our head so I could go to work. I was in the gym most of the day anyway. And then when I was home, we'd just go out and get pissed. So it was literally just a place to shower and to sleep. And it was perfect for that. You're completely right about the emotional thing. So I got my visa. Then this is how it happened. My business partner said, I've just got approved a loan. You should talk to him. He's got all our company accounts. So I messaged the guy. Was like, hi. Income Bank. I was like, what am I cleared for if I wanted to get a mortgage? He said, I could easily do $2.5 million today. Wouldn't even have to get you to come in. So then I was like, okay, and that's because we've got 8 years of company history and like 100,000 people to do the training up. So straight away, I kind of looked at it as free money. Then the emotions came in. I started looking around Bondi. Started having a look. I was like, I could have an apartment, could have this, could have that. Then I started looking around a bit more rural. Then when I saw the house I live in now is the first house I ever looked at. So the car I drive now is the first Porsche I've ever looked at. I'm that impulse emotional buyer. The second I see it, I want it. Now, I'd seen a picture of the house online and there was one picture of it opposite the sea. And I go, I wonder what lens they've used on the camera to make it look like it's that close to the sea. Because people can be very sneaky the way they go on a balcony, get the 50mm lens, take the picture. And then you get there and you're like, hold on, I'm the other side of a railway track away from the ocean.
The other one is that agents love using is location shot. So it's not actually from your property, it's just down the road, like you'll be able to see water.
And you can tell when there's like a bad property, when the house isn't in the first image. Yeah. So then I get to the house and the ocean is there. I can see the waves. I can hear the waves from where I'm in the vicinity. It was a complete emotional investment. I'm completely honest. I never imagined I could be that close to the water. So straight away, I said to the agent there, I've been in the house for 4 or 5 minutes. I went, I'll take it. Straight away. And then I even said to him, tell me what they want. I didn't negotiate. I said, just tell me what they want. And he came back to me that night and he said, I made an offer. He goes, if you go 30K above that, they'll do it. I said, fine. It was pure emotion. I didn't care because it wasn't looking at it as a business. But then the way I'm paying it down is kind of treating it like a business where I'm not leveraging that. So the other thing that we get incentivized, this could be a trap that I've fallen into in Australia, is you have offset mortgages here, where for anyone in the UK, any money that's in my current account pays down my mortgage in real time. So even if I get paid a dividend from one of my businesses, chuck it in the offset, repayments go down instantly. We're being financially incentivized to save, which now hearing that out loud, talking about how bad saving is and how, your money's getting eroded down, is a terrible idea, but it's definitely a trap you fall into. What would be the play for me then? If, because I know you've got a business and this is kind of what you help people do. And that's why I was so keen to talk to you today. Is my play to start taking out liquidity from that offset and starting to diversify it into property? And if so, what is the kind of gold standard? Are you looking to put minimal deposits and pay interest only? Or would you say, oh, I'll tell you what, maybe go 30% down payment on this one and do principal and interest? What is the kind of gold standard play for someone who's fallen into the same trap that I potentially have?
The debt that you have on your home that you live in, no tax deductions, right? So let's say, for instance, you've gone out there, you've got $1 million loan. Every time you pay towards that mortgage, that interest repayment, that cost, the tax man doesn't care. Like, that's your cost. But if I had the same thing on an investment property, they're going to say, okay, cool. We're going to take that into consideration when we calculate your tax at the end of the year, which is going back to that negative gearing side of things. Now, what I could do if I was in a position where I've had, a $1 million loan, I've now started paying it down. Instead of going down the path of I've got liquid cash, I'm going to use the liquid cash straight into buying property, I would take it a step further, right? So there's a step before that, which I would use the liquid cash, pay down my mortgage, right? Then go and refinance that out so the same portion comes back out. And you'd be like, well, that sounds stupid. Why would you do that? Reason is, now the tax man looks at it and says, okay, cool. Thank you for paying down your loan. I don't really care. But now you're taking back that amount that you paid in. You're taking that out as equity to go and buy an investment property. Well, because it's come out of your own home, that doesn't matter. It's the intention that you have behind using that debt. So that equity that you bring out, if it's for the purpose of investing, now we're going to calculate that as tax deductible debt, which is fantastic, which is where you want to be. So you want to eventually convert all of your non-tax deductible debt, which is in your home, into tax deductible, which is going in, and I'm going in with the purpose to invest. Now, people have different risk appetites. Normally, the whole idea behind leverage is if I go and put a 20% deposit down versus a 10% deposit down, you're going to pay a little thing called lender's mortgage insurance. But now my returns are effectively doubled. Because if I'm going in to buy $1 million property and I put a $200K deposit versus a 10%, which is $100K, if that property goes up by 10%, on the first example, being the $1 million, 10% is $100K, I put in 200. So I put in 200, 100K, I made a 50% return. But if I now halved the deposit, being 10%, I'm now getting a return of 100% because it's gone up by 100%, I've only 100K, and I've only put it 100K. So you're effectively doubling your returns by leveraging even more. Now, obviously, that comes with the caveat that, you know what you're doing. So most people, they often go, okay, I'm going to put a large deposit down so that I'll get the best rate. The best rate drops by 0.1%, which is nothing. But if I had the option of going, I've got a 30% deposit, I'm not going in 30% deposit into the one property. I'm going 30% deposit, let me go buy the 3 assets, because I know when I decide to do this and finally understand how it works, in 2 to 3 years' time, I'm going to go, let me buy that second property. I should have done it years ago, but I'll do it now. Oh, sorry, it's gone from 650 to 750. That's okay, I'll buy it now. And then you're going to do the same thing for the third one. Instead, the whole game is to go, how do I hold as many assets as possible for as long as possible? And what you do is you inbuild emergency funds so that you lose your job, people watching, they might go, my income's dropped by 50, 60%. You create emergency buffers so that when times are tough, you're always going to win. So you win when the market goes down because now you're positioned to go, if there's a market crash, which it's going to happen every year apparently, when it does happen, because it will, you're going to be positioned the best because you're comfortable taking risk, you understand how the property game works, and the banks love you because you made your repayments all the time. So you've got now a position with the bank. They know that you're going to make your repayments. Your value on paper has gone down slightly, but you can still borrow enough to now pick up the assets that are down 20, 30%. And when the market flips again, because we know governments have to have property work, especially in a country like Australia, you're going to win on the way up and you're going to win on the way down. And so whether it's interest rates going up or interest rates going down, if you structure it the right way, you don't care about, hey, my value went down by $10,000 today because you're not selling it. And usually what you have is when the market's going up, there's a thing called rental yield suppression. So the return I get from income for the rent versus the property value is not that great because the property value goes higher quicker than the rent goes up. But when markets are downturning and no one wants to get into the property market, they all flood for rent. I want to go rent something because I've lost my job or I've lost this house. I've got to go rent something. So your rents start picking back up. Guess what? The rents don't usually come back down. They just stay up, and then you suddenly have the next leg up in the cycle.
So this is such a lucrative opportunity and such a great use of capital, and it's such a great place to invest. And so many people should be doing this before buying a first home. Why isn't everyone doing this?
because of emotions. There's people around you that constantly tell you it's the wrong move. They will constantly tell you you should buy your own house. And if you have, like in my case, my parents are here. They've been here for 40, 50 years. They just know what they know. So they're going to say, if you're going to ask me for advice, I can only tell you what I've done well in my life and what's worked for me. Bought a house in Sydney. It's worked out for me. You should do the same.
Yeah, okay. Yeah, it's exactly right. So almost like a survivorship bias. I'm happy in my house because I don't also get to see all of the failed returns that I never invested. I don't get to see where the offset that I've paid down on my mortgage could have gone or could have spread or could have potentially been. I just have the results I have. Oh, my repayments are only a couple $100 a week now. Do what I did. But they can't do often what I did. Okay, so devil's advocate here. So you have a team of people that find properties.
Correct. So we basically have people on the ground, we have people in the office, and we essentially build relationships with agents. And the agents will go, instead of me going out to the open market to go through the campaign, the marketing campaign, go through open houses and all of that, I'm going to go to these guys at Search Property, the buyer's agency that's going to help me get the buyer. For us, we're incentivized because they're not paying for all the marketing costs, it's not an inflated value, which means we're probably going to get under market. Also for the seller, they're loving life because they know that as soon as they attach themselves to us, we're not going to have the random call in 2 weeks' time, oh, my finance fell through, or hey, I'm nervous, like, should I do this? They're like, I know this transaction will go through. So there's pros for both parties. And so essentially we go out there and say, cool, James wants to invest, he's got this much money, this is what the strategy looks like. This is where you want to end up. And you go, oh, I want to make $1 million a year, I want to buy a few nice cars. Okay, cool. We readjust things. The earlier you start, the smaller the adjustments need to be made because it all compounds. But if you come when you're like 55 and you go, I want to retire at 60, now you're probably having to take a lot more risk to try and get to that end goal.
Okay. So and this is very interesting for me. Then the next thing I would say is, what's in it for you? What's in it for your company? Because even if you were to sit there, I actually joked with you before, showed you my car downstairs, and Porsche told me how much it would depreciate, and they were honest. I see it hurt you to know that it would lose 50 grand a year. You're like, well, you're probably thinking in property, how many properties that is. But to me, I really rate honesty. Even if you're drinking in a pub and it was $20 a pint, let's say, you go, $20 a pint. He goes, all right, this is the nicest room, the comfiest sofa you've ever sat on. That sofa cost me $5 grand. Enjoy your bloody pint. I'd be like, oh, do you know what?
I appreciate that.
Yeah, I appreciate that. Fine. I'll give us 2 more. So talk to me about rates, fees, because ultimately what I'm going to potentially propose to you is that we do this, but you're going to alleviate the anxiety, the emotion. That's really why I would hire a business such as yours. But let's talk about rates. What's in it for you? Because if you go, no, we're just trying to help people find property, I'm like, it sounds too good to be true.
As soon as you get someone online, you would know this as well. Oh, I'm not in it for the money. Come on, you're not running a business to run at a loss. There's other things that give you a lot less headache to do that. So for us, really upfront in terms of transparent fees, $20K, right? So if you go, okay, I want to buy a property, you're just going, I'm now paying $20K on top of what I was going to pay. Like, I could just go find it myself. Cool, you should do it. But there are all these stages within the buying process that you're going to falter at. And we know it because you're in this position for a reason. So there's analysis paralysis. You're going, oh, it could be this, but is this the right option? Like, oh, how am I going to do the due diligence? I've never done this before. So often you go $20K upfront. The fee's broken down into 2 parts. So you pay like a $5K retainer and then the rest is upon settlement. So we're incentivized to walk you all the way through. Now, some people will go, well, who cares? In your case, you're going to get paid regardless. If the property goes down, you're still going to get paid up front. If the property goes up, well, awesome. We are incentivized because, as you know, in business, it's a lot easier for us to retain clients and have repeat purchases rather than just go for new people because it's going to cost a lot more to acquire those customers. So for us, we've got a lot of clients that come to us and are now on their 5th, 6th, 11th property. I spoke to someone yesterday. And so what ends up happening is we're incentivized for that property to go higher, for it to perform to get to where you want to be. Now, obviously, passion-wise and doing the right thing ethically, for me is like, okay, I can tell you upfront it's going to cost you $20K. You decide if it's worth it or not. And if it is, we're going to do everything in our power to get you the return upfront by getting it under market value and whatnot. But overall, you didn't have to lift a finger and you got to make that move that you wouldn't have otherwise, right? So for us, it's If you go out there, get a good result, you're going to come back and pay us another 20K and then another 20K.
So yeah, that's the exact honest pitch I was looking for. You're going to go, hey, you're going to make so much money. You're going to be giving me 20K every month. So, okay, let's say I say to you right now, okay, cool, let's do my first property. What ballpark figure would we be looking at for a property for a first time? Would that be your decision or my decision?
It's a combined one. So we need to dig a little deeper into the finances and also realize what your goals are. So we would go straight into sort of going, okay, cool. You can come on board. You want to use the service. Fantastic. But let's now get granular. What can we actually afford? And you might go, okay, well, we speak to the broker or the bank and they say, I can borrow $2 million. Cool. We can slice that in a couple of different ways.
And would I be better off going to my the bank, or would I just say, hey, I've already paid down some of my mortgage. Why don't I just give you some of that?
100% you should be going to a broker, not a bank. So a lot of people get caught up in this because that's what I got taught as well. And I made the same mistake, which is I just go to the bank that I've been banking with. They know everything about me. But when you go to that person, they only have one option, which is the bank they work for. Outside of that, any of the other policies that might be available or more lucrative or incentivized for your situation, you'll never know about. So a broker is literally that middleman and they get paid by the banks. So you don't pay them anything. And they go, cool, James passes all financials. This is what it looks like. This is what your property is worth. This is what you can do. If you go to this bank loves you because you're self-employed. This bank hates you because you're self-employed. This bank will give you better rates, but when it comes to valuations, it's going to be lower. So if you're intending to take out equity to go and buy numerous properties, build a portfolio, this is the lender you want to go with, not these ones.
Okay, because I would have thought, okay, I've overpaid my mortgage. Let's just grab some of that, chuck it at you. I was even going to get my phone out now and say, if I give you $100,000, what can I get? But you're completely right. I need to, because for me, I suppose I'm in this busyness trap as well. Another reason is that I've not made any phone calls. I've not spoken to any brokers. I was excited to have a conversation with you today because it would double up as a podcast as well. But it seems like stress because now I told you I hate debt. I've got to call someone to get debt. But okay, so I talked to the broker. Would he then say, we think you should borrow roughly this amount of money? And would it be a case of borrowing the maximum amount you can to get the biggest property you can, or would it be about starting small, biting off something at the bottom end of the market, getting a feel for it and working your way up?
Yeah, I like the idea of going macro, which is this is where we could end up should you want to go and execute and you have to get to 7 properties to get there. Now let's go back to the micro, which is you need to dip your toes before you jump into the water, right? Because we need to know that you can work with us and I can deal with what this comes with, right? Because everyone's different. And so as much as, just like an interview, as much as you're trying to suss out the company, they're trying to suss you out as a candidate. That's the same sort of process we take. Because if we want to do this time and time again, you don't want to get someone into your ecosystem that's going to cause you more trouble every time you have to deal with them, because everyone's going to go, I don't want to deal with that client. So essentially you get to the first one and say, okay, cool. So in order for me to go for this property, how much do I need in terms of borrowing? What structure do I need? And that's where you almost go into this idea that I could go to any buyer's agent, and there's some out there that are charging like 40% less. But they don't come with the strategy and the people around them, which is, okay, I need to speak to the right accountant who's going to know what these guys want to do. And I'm going to have to speak to a broker that actually knows how to structure this, because like more than 90% of what brokers do are for owner occupiers. Because people want to go and just buy their own home, come in, let me do that. But if you suddenly go, hey, I'm going to have trust structures, I'm going to have a bucket company, the money's going to come in here, and this is what we're going to do, we're going to invest. Oh, I don't know how that works. I don't want to get involved. That's too much work. Then you've got other things like people investing in their super funds and self-managed super funds. Some people will not touch it because it's a lot more work than you just going, I really like the house down the road. Can I buy that? Yeah, no worries. This is what you can borrow. And generally you're going to go way, way above your means to buy that house. And they're going, great, I get my commission, happy days. But this requires a bit more strategy and it's constant. So for us, as part of that 20K, that technically as a buyer's agent, that's all we have to do. Find you the property, 20K, no problems. But for us, we know and we're incentivized that if we stick with you every 3 to 6 months and go, James, look at your property, it's gone up in value. Hey, you've changed this. What's happening here? The market's shifted. You're more likely to make another move because you're more well informed. And being busy, you're going to go, well, I don't have time to see what market's gone up or market's gone down. How do I know I'm getting ripped off? So you're almost going, I'm get to partner with someone to not just make the transaction, but also have my back. And when something is changing, they're going to be in front of it because guess what? They do it 24/7, a team of 50 people. I'm doing what I do well. You're doing what you do well.
Yeah, because the paralysis I found just looking online, trying to find out what's good, what isn't. Interstate, I've got friends that have bought properties in states they've not visited for years. And to me, that just seems so weird. But you're completely right. This all stems from me making an emotional investment in a home based on emotions only, where I went out of my means, where the repayments were uncomfortable, to where I excessively overpaid. It's all a cascade of emotions down from what most people think you should do and the kind of trap that you fall into. Okay, so then I would challenge you here. Do you ever think that potentially, or let's say you have a client comes to you, they want to start investing, and they have $1 million liquid. Would you say to them, put it all into property? Or would you say, hey, mate, why don't you give me half? We'll get this, and why don't you put something else into something else? Do you still support diversity of financial investments across a portfolio? Or would you say, mate, put it all in property?
Depends at what life stage you're at. But if I was to just go general and based on everything I know about you so far, is I would go down the path of saying, if you're going to go down property, this is what your return will look like. If you go down the path of shares, this is what your return will look like. And if you go and do in your business, this is what your return will look like. As a business owner, I can tell you nothing will compete with your business. So if you go into this entry and say, oh, my property is going to make me more money than my business, no, it's not. Because you can actively control that. If I go in tomorrow, I run ads, I do 50% off my mentorship, I'm going to make a lot more as a return on investment in that short period of time. It's breaking it all down and then assessing what's your risk level? What are you willing to go with? Based on what we've had a chat about, you're more likely to go, I want to dip my toes, but if I understand how this game works, I'm all in. So the idea is to show proof that it actually works and going along on that journey to go, I see why people do this. And for someone in business, and this is why, 30% of the people we deal with are people who run businesses. It's amazing because as soon as the numbers make sense, they treat it like a business, right? So you go, okay, I'm outsourcing a portion of my business. I go to an agency to do my marketing because I don't know how to do it. I don't have the time for it. I'm not interested in it. Same sort of thing is now I've got this machine getting built in the background. And eventually you get to a point where your property portfolio is going to be making $300,000, $400,000, $500,000 on paper, just in equity. And your costs are going to be $100K negative. But every year that cash flow negative continues to go lower and lower and lower. And so suddenly if I go to you, hey, imagine if you could go and buy a business, the revenue is $500K, the cost is $100K, so it's 80% net profit. That's a pretty good deal. I would love to run a business like that. Oh, and guess what? It's totally passive. You don't have to do anything. Yeah, sign me up. How do I sign up for 10 of those?
I think for me, I wouldn't actually care about the money it makes. My biggest concern is loss aversion, that I'm losing money by not investing it. So even if you were to say, I've got some properties for you that's going to protect your money from eroding, that'd be enough. I don't think, because that's the most painful thing for me. To be honest, I think I was 34 when I even really knew. Do you know, I didn't really understand that much about mortgages till I bought the house. Didn't care. Wasn't part of anything I was doing. I actually said to the guy, I'll buy the house. Then on the way home, I think I ChatGPT'd how a mortgage works. I just never cared. I just rented and whatever. And then even the last few months, I've run so many things through ChatGPT, which isn't obviously accurate, but hypothetical. What state's the best? Lender's insurance, do this. And it's very difficult to get a good response from it. And then whenever you say, hypothetically, if I was to do this, the results you get from it aren't really that good. But even now, I think the last year, even just learning about inflation, I watched a video the other day, and I always say to people in that content creation space to give people aha moments. I saw a video where it goes, a little bit of inflation is a good thing. I never knew that. Fucking 36, man. I could tell you anything you need to know about muscle growth, fat loss, social media. I could tell you the settings that these cameras need to be on the FX3s, but I couldn't tell you why a little bit of inflation was a good thing. So the fact that the more I learn, the more I realize I'm potentially losing all the time. And the system is kind of rigged against the ignorant. Will it make me a bad person to invest in property and to build a big property portfolio? Or is there a virtue that comes with it where you're like, I'm providing homes for people?
It's a very interesting conversation. The way I would go about it, and at least if I speak about my portfolio, right? 20 plus properties worth 25 mil, and it grows on autopilot. So if it grows by 5%, it makes $1 million a year. Fantastic. the counter to it and comments, come and remind me and humble me real quick is, oh, that's 20 properties that people couldn't buy. So it's 20 homes that people could live in, and there were multiple people trying to rent that property. So unfortunately, I'm just part of this game. We all are. And if I sit on the sidelines to go, okay, well, I'm not going to do it, someone else will. And the government themselves, you've chosen to live in this country, and the government themselves are incentivizing people to go and do these things, right? To go out there, build wealth, protect your wealth. And the only way you're going to do it is through assets. Now, breaking it all down and putting it real honest on the table, I'm sorry, but I don't care about Joe 69 in my comments. I care about my family and my future kids. And so I'm going to go and do what I need to do to protect them and protect my wealth. And I'm doing it in a country that literally wants that to happen because they're incentivized to it.
Like, even I was listening to some of the political parties talk about, they never say we're going to make housing more affordable. They say we're going to make buying a house easier. So you can already tell, because both political parties, the leaders, have investment properties. Am I right in thinking that?
That's correct.
So already, no matter, because in the UK, there's like a Greens party and, tax the rich, and you got Labour and the Conservatives, and you got all of these kind of people thinking that if they vote for the Greens, then maybe they'll abolish landlords. But in Australia, like you say, it's very apparent that this is never going to change, because it means that people would have to erode their own wealth to get elected. It just doesn't seem like it's likely.
Not only that, but like you mentioned the Greens, some of the policies they come out with, you're left scratching your head. One of the policies they came out with was, there should be a rental freeze, and it could be for 3 to 5 years, so you can't increase your rents. Sounds great as a tenant. You're like, that's fantastic. But now think about it. From a landlord's perspective, they have no incentive to go and improve the property at all. Their costs are going to go up. So they're going to go, well, actually, it doesn't make sense for me to have this house anymore. I'm going to sell it. Even if I cop a 10% loss, I don't care. Like, I'll just put it in the share market. Now that house is available to buy. The person that can't afford to rent is now all of a sudden going to can afford to buy the house? No, they can't. Now they have to move out of the suburb altogether. So while it sounds good on paper that, you can come in and, it's screw the person that's going to be the landlord or screw the person that's really rich. It's like, if you actually play this out with, modern day economics, it actually does not work. And so that's why we get into this position where the major parties will come out and say, well, yes, we're going to try and we're going to help the average Joe. But all they do is they actually just inflate the prices even more. And the people that can buy multiple assets continue just to layer on top, and they keep growing. It happened in the pandemic. So when they came out and said, everyone's got to stay at home, there were stimmy checks, so stimulus coming into the market. And everyone that was getting them thought that this was amazing. So for a couple of years, you've got people getting money just to stay at home. What people do is they use that money to spend, and they spent it in businesses that are owned by the rich. And so now the rich are going, I've just made all this money, and I know this money has to find a home, so I'm going to go and put it into assets. And so the assets go up in value, and everyone thought, which was a free handout, and it was a nothing burger, like, we got free money for a little bit. Now we're paying for all the consequences of that. You don't just get money printed out of thin air and not just think anything's going to happen.
I saw a clip online. There is one thing that some people could be listening to this. They go, Declan here, 24, Gen Z, fucked. I'm joking. But if we look at even Declan does all right as far as the salary, but then if you're looking at the average salary of someone his age, the average property price somewhere that he would, if he says he's moving to Victoria to save money for a cheap rental, he's out of a job. So he has to live kind of Sydney, kind of around this area. He wants to save up, and they want to buy a house. The emotional investment, let's say he wasn't listening to any of this, he wants to buy a home. They go, well, after expenses, I have to save for 14 years to get on the property market. Someone I saw in a clip online went, how old are you, mate? He goes, yeah, I'm 22. He goes, well, your parents' house will be worth fucking millions by the time they hand it down to you. So you're going to be a millionaire when you're older. So just relax, just rent. Is that a fair, comment to say to people, some people anyway, that might be crying? They might be saying, I can't get on the property ladder. They go, well, all of the things that have fucked you as Gen Z mean that your parents' house has been inflated a huge amount, and you will one day inherit that. And you're in a country without inheritance tax.
I think this idea, and we've got a couple of people in the office as well, Gen Z, young people, when they listen to this content all the time because they're shooting the content. And they often ask me after, off camera, and they're like, well, what's going to happen to me? I'm like, well, firstly, and I'm not saying everyone, but in their case, stop going out to the cafes every week, and now you need to knuckle down. And if that means take up a second job, you need to go above and beyond, because owning a house, I think in Australia, is going to be a privilege. I don't make up the rules. Like, we're headed in that direction. And the best way to show this example is you would have loved to live in Bondi. You would have loved to have a house next to the beach. Couldn't afford it though, so you move somewhere else. Why have we now just gone, well, everyone should have a house? Well, is that the case in London? Is that the case in New York City? No, it's not. So in the eastern suburbs of Sydney, I don't sit there and think, oh, I can't wait to buy that $20 million house. No, because it's out of reach. So you just look at it on Instagram. But in reality, you're just like, okay, if I get a unit in that place, I'll be happy in that area. So then you continue moving out to places that you can afford. And so I think over time, we're going to find that every house in Australia is going to be worth at least $1 million. And for people that are young, they're going to have to go above and beyond. And we didn't have things like, when I was doing uni or 10, 15 years ago, I didn't have the ability to go, I can work a job, go home at night, build up an Instagram page, learn from people like yourself. And maybe I can make an extra 10K, an extra 20K. That gets me further ahead. You got to lock in. And unfortunately, we're at a time where you cannot afford to make many more mistakes, if any, to be able to get further ahead. So it's sad, but I think owning a house in Australia is going to soon become a privilege, and we're going to end up becoming this nation where everyone just rents.
It's if we'd sat here maybe 5-6 years ago before I bought a house, I used to say to people actually very similar to that. I'd go, rent somewhere you want to live because you're not going to buy there. And I've seen so many of my friends in the UK, they live further away from their work in an area they didn't want to move to, but it was the only place they could afford. And the only way they could afford it was to get a mortgage with their partner, who they're no longer in love with. So the amount of friends that kind of fell into that trap, they go, I must own a home to live in. Oh, my partner means that I could double my borrowing capacity because we're both working. Boom, they buy a place, and they're so emotionally invested in that their commute from work has gone from 15 minutes to 40 minutes. It gets worse in traffic. Then the commute means that they're more stressed. They're spending money on the commute. Trains in the UK are extortionate anyway. Then they're coming back to the home. Then they're 25, 26, realizing they don't actually love that person. So there is almost like a positive tone to this. You can say to people, look, rent, freedom. Also, I used to joke around when I was renting, if the boiler broke, not my problem. I was renting in London. I shouldn't say this. Well, fuck it. I used to finish jiu-jitsu, and there was this beautiful full wall radiator, like a big black radiator on the wall. So I'd come home from jiu-jitsu, shove my gi and everything in the wash, then I'd chuck it all on the radiator and it would all dry, it'd be great. And one day I was running out of the house and I pulled the gi and I heard something, but I was like, oh, hopefully I've not broken anything. Come home later that night, the radiator's fallen down, flooded the whole kitchen. And I just texted my landlord and I was like, I'm really sorry, your radiator's broken. Like, I'm really sorry. Don't know what's happened. Radiator fell off the wall. I wasn't even here when it happened. I went to my mum and dad's for the weekend, and she messaged me 2 days later. She was like, it's all sorted. She's like, my brother's got a plumbing business. We've sent someone around. They've cleaned up, come back, came in. It was as if nothing had happened. And apologies to the lady that owned that property in Richmond. It was me zealously pulling my gear off on the way out. And there was that part of it where whatever happens here, not my problem. And to be able to live and have the freedom to do that, and also to reinvent yourself. Like Declan could have a midlife crisis tomorrow and tell me he's moving to Japan, and he can do it. And although it can seem like really doom and gloom, that does give people the opportunity to figure themselves out. Because I actually credit although my dad told me not to get in debt, I credit him, and I've said this for years in books. At 26, I said to him, I think I'm going to go to Australia. And I had $6,000 in savings.
And why Australia?
I had a psychedelic trip.
Nice.
On ketamine, actually, which is an interesting one. People think I make this up. I'm at a festival called Ultra in Croatia. And I've just done a massive bumper K at Martin Garrix. And there's something called a K-hole where you start to sorry, mum. You start to disassociate from reality a bit. But you're still there. You're still loving the music, still everything. And I had this really introspective conversation where I was working in a gym in Bracknell. I was doing well. I was the most paid PT there. But the voice in my head was like, if you want your business to go to the next level, you're probably going to have to move to London. And then I was thinking in my head, well, I don't want to move to London. I don't really like London. And I was going through the mental gymnastics on the dance floor, where else I could go. And it was like, well, Sydney is perceived as the capital of the fitness scene, etc. So you can get a little bit wobbly on your feet when you do ketamine as well. And we all went into the realm together, let's say. Some people listening will be laughing. They'll be like, that's exactly what it's like. Sometimes you go to different dimensions of reality.
Okay. It's good that you're explaining this because I've never done drugs in my life. So this is good.
Not yet, he hasn't. And you can't explain it until you've done it. Like psychedelics, you can never really explain until you've done them. And it's not like you see elephants appear in the room that aren't there, but the design on this table would just start to misbehave. And you'd feel incredibly safe watching it. And you'd realize that your senses that you have been fixated in a way their whole life and that they can be changed just by taking some mushrooms or whatever. Anyway, so my friends, we all come back because it's about a 20-minute trip, come back together, and someone will be like, right, let's go to the bathroom or whatever. And my mate's like, you're right. It's like, I'm moving to Australia. He was like, what the hell? Like sometimes people would be like, oh, I thought the dance floor was moving, or, I forgot where I was or anything like that. And I came home and my dad was my soundboard. We're having a barbecue in the garden. Might go to Australia. And part of me thought he was going to go, you should probably find a partner, you should probably get a mortgage, you should probably settle down, you should probably start a family, you should probably do all of that. And he just goes, always imagined you living somewhere like that. That was the first thing he said. And at this point, I had 2,500 Facebook followers, no online business, was just a four-walls gym. Everything that happened in my life happened through financially doing one of the stupidest things ever. Even my best friends, like you say, your friends say, have a house, whatever. I said to my friends, I'm going to Australia. They were like, are you fucking stupid? They're like, you're the highest paid PT at the gym. You've got a full diary. You fucking go home and nap before rugby training. You've got the best life ever. Why are you going to ruin it all and go to Australia? And by coming here and renting, and even at 27, let's say, 2016, 2017, on paper, I was renting while all my friends had bought houses. I was just figuring myself out. I was figuring life out. And I suppose, although financially reckless at the moment, 10 years ago, I was completely financially reckless, but that freedom from renting meant that I could go across the world, start a new life, start in a new location, do whatever. And I just know that so many people can do what they think is the right thing, buy a property, live in it. But like you say, it's emotional. The reason they stay in a relationship that's not fulfilling them, emotional. The reason they stay in the job they don't love, emotional, because they've got a mortgage to pay. The amount of people that I work with on a business perspective, they want to be an online coach or they want to be whatever, personal brand. They go, oh, but my mortgage repayments are this, and it's high because they bought their dream home.
Mm-hmm.
And I'm working a 9 to 5 that pays the mortgage. I can't quit the job I hate because I've got this massive overhead. And then you've got the emotional consequences of losing the house. That could probably be one of the biggest psychological pain points that any human being could face, losing your home.
Which is why it's the last thing that goes. So if you have some sort of correction, the last thing people will lose is their own home. So they'll stop eating Uber Eats, they'll quit their gym membership, they'll do everything possible to not lose the home. And you mentioned something really important, which was because now people are putting themselves in this debt issue, and again, conspiracy, I think it was all by design. It was so that people would stay at their jobs for as long as possible. So they go, you get a house, you get this large debt. Guess what? Now you're screwed. Because if you decide to go, I'm going to go and take a year off and travel and find myself, or I'm going to go and start that online business that I wanted to give a go at, no, you can't. Because now you lose your house. Oh, okay. Well, I'll just continue going up the corporate ladder
and
and
they
take
keep
my
having
job.
to pay taxes. And even people that do become self-employed come into a tax beneficial position.
Correct.
That's very interesting. Okay, so anyone out there, similar position to me, obviously we've got your book here, we're going to plug your business in the description. Someone in the UK, someone anywhere there is, obviously quite generic advice. Let's go through a couple of scenarios quickly. Not bought, currently renting, quick 60-second game plan.
Depends on how much money they have, but if they've got enough to get a deposit together and they've got an emergency fund, I would go and get a strategy first. Do not go online, do not go and search for properties, go get the strategy and get it with someone who you know has been or is where you want to be. So for a couple of steps ahead of where you are.
Second scenario, someone is saving up, they're about to have the 20% deposit they need for their dream home. It means that the financial repayments are going to be pretty high, but they're going to tighten their belts to live in their dream home. They're probably late 20s, early 30s. Is there a potential course recorrection they should consider?
100%. And the best way to do it, you don't even have to contact me, is you literally sit there, do it on an Excel sheet and be completely unbiased. If you've got someone like ChatGPT, unbiased, so obviously put the prompt in so that it's not going to just agree with you, and figure out which one is the most logical path forward. And if you can get an advisor on your side, and if it happens to be Chat or happens to be Ravi, same thing. Like, you want to be able to go and say, is this going to make me financially happy and have less financial stress? Or am I going to find myself in 5 years going, I hate my life?
Scenario 3 would be myself. And I've actually just realized why the brokering thing would make so much more sense, because is any money I take out my offset is going to increase my repayments on the house. So if I just keep that there and take out a separate loan, I'm I'm still going to be paying the same amount of cash flow anyway, but I could just be getting a better deal. So then someone else, like myself, been paying down the mortgage, really aggressive, realizes they're potentially wasting money. Where do I go?
First, get yourself aligned with a strategic mortgage broker, so someone who knows what they're talking about. Figure out what the end goal looks like. Is it, again, I'm going to have a house paid off? How long is it going to take me? And then what? Is it that I'm relying on my income actively, or can I build something out properly? And again, everything sort of comes back down to the strategy, talking to the right person, because again, our parents taught us what they knew and they did the best they could with the information they had. Now, I assume the way that you're parenting your child is very different to how your parents parented you, because there's new technology, new information, and you're probably like scrolling and saying, oh, I didn't know that, right? So now we're in an environment where there's so much more information. It's also a case of everyone's got a different strategy. So figure out what aligns best with what you want to do in terms of your goals, and then work backwards with those people.
Final question, which every financially literate person that I've spoken to, I've said, are you concerned that if your portfolio outperforms everything you could ever expect, that your kids will grow up in a dysfunctional world?
This is something that I speak to my partner about, my wife, and we're expecting a child in the next couple of months. And we're sort of trying to figure out how much do we tell them, but also they could just go online and find out. So I haven't figured that one out, to be completely honest, and I'd love to get your thoughts on it.
I said to Damien Talks Money the other day about it, but we'd finished recording. I said, do you ever consider yours every fucking day? Every fucking day. So like, there's a part of me where my dad, who obviously been a very important figure model in my life, he went through life probably not spending his money right. He laughs. He says he used the mortgage as an ATM in the household time. But that meant I had a great childhood. So as my dad squandered his retirement, and now fortunately I'm in a position that I pay his mortgage, but I look back at all of those poor financial decisions he made, and I enjoyed the fuck out of it as a kid. So although I'm having to maybe pick up the pieces a bit in my 30s, absolutely, I kind of look back and think, I'm glad he wasn't smarter, because if he was smarter financially, maybe we would have had a tightened belt childhood where we didn't go on as many trips and we didn't go away as much and we didn't go out for nice Chinese dinners or whatever. So I think you're fucked both ways. Either you squander your wealth and your kids are great, or you're financially incredibly literate and you've got to keep a finger on the pulse of your kids' behavior. But you could just be moving into a one-bed in Bankstown in 5-10 years just to make sure that, the kid's growing up and not getting too big for his boots. Ravi, thank you very much for coming on. That's been incredibly helpful for me. Anyone listening, plug the books, the business, the YouTube.
Appreciate it. No, that's it, man.
Do you want to plug books, business?
No, I think it's just, if you like what we chat about, come to the YouTube channel, just check it out. And I think you're going to get a vibe of whether we're going to work or whether we're not going to work together, but at least you're still going to get some free education.
Thank you.
Appreciate it, bro. Thank you.